Hello, welcome to this episode of The Financial Incline. I'm your host, John Bovard. Today, I'm thrilled to be joined by Griffin Hurd. So Griffin and I had a recent conversation in the live stream video within our Facebook group, Building Wealth for Business Owners. Griffin is a certified public accountant and partner at local CPA firm Brixey Meyer. He works in their transaction advisory group, and he helps buyers and sellers that are contemplating a transaction with the financial due diligence process. So for those of you that don't know, the financial due diligence process is a much more extensive process than simply evaluating a balance sheet and an income statement. During our conversation, we discuss why it is important to go through this due diligence and how do you determine truly what a company is worth. We talk about some of the key focus areas that he looks at within the financial due diligence process, and also talk about the net working capital adjustment and how that plays a factor when you're evaluating a business. Lastly, we discuss when is a good time to engage Griffin and his team if you are looking to buy or potentially sell your business. I hope you enjoy. So Griffin, thank you for joining me today to talk about the financial due diligence process when you're evaluating a business, whether you're buying a business or getting prepared to sell your business. We will be walking through a couple of the major topics and why that's important. So for those of you that are joining us live, I appreciate you tuning in. And Griffin, so for everybody that's listening in, would you just mind sharing a brief introduction as far as what you do and who you work with?
Yeah, no, thanks, John. Appreciate you having me today. Hello, everyone out there in Facebook world. My name's Griffin Hurd. I'm a partner with Brixey Meyer. And I always like to tell folks that our firm, we're a group of strategic accountants, business experts that we really passionate and excited about working with growth-minded individuals and businesses that really want a strategic partner to help define goals and clarity. And, one of the ways that I kind of live out that core value of our firm is within our transaction advisory group. So part of why you had me on today, John, within our transaction advisory group, we're focused on helping both buyers and sellers, not at the same time, but helping both buyers and sellers that are contemplating, an M&A transaction, and primarily assisting them through what we call, a financial, operational, and tax due diligence exercises. One of the primary ways that we assist folks looking to enter into transactions.
Yeah, great. So Griffin, we were introduced through Aaron Monk, and Griffin helped us out for a recent business acquisition that we made earlier this summer that I know I've talked with many of you about. So did a great job with that, with some of the due diligence and some of the net working capital calculations for us on that. So we'll go ahead and dive right in here and really just so we can get an understanding. So what is financial due diligence and why is that important?
Yeah. So I like to describe it, John, is, at the end of the day, kind of through a financial due diligence exercise, we want to make sure that we're kind of painting the picture of a business, over a historical period, typically over, 3 to 4 years, looking back, what's happened within the business over that historical period, not only from, a financial side of things, right? Obviously important to understand the financial trends within a business, but what other major things have gone on within the business? Did you do a couple acquisitions along the way? Did you divest? Did you restructure? So at the end of the day, it's kind of painting that big picture about what the business has done over the past 3 to 4 years. And I always kind of view it as, I kind of call it like 3 kind of main inputs, if you will, to a typical due diligence exercise. The one that you hear probably a lot is quality of earnings. So typically, with the quality of earnings, we're looking at, what is that EBITDA of a business, EBITDA, earnings before interest, taxes, depreciation. And that's important because that's typically a proxy for, the free cash flow of business that will often translate into, hey, I'm going to slap a multiple on that based on my industry or the market that I'm in. And that might become my purchase price, right, for both a buyer and seller. So it's important to understand what is the, reported and also normalized level of EBITDA over the past 3 to 4 years. And that's a key exercise, right? Because you can pick up a set of financials and easily compute EBITDA, but through a due diligence exercise, you can understand, okay, what happened during, what happened 2 years ago, what happened a year ago that, hey, this was a one-time thing. Like, hey, I lost a key customer, or COVID really impacted my business, or I restructured. What are those things that we should be factoring when looking at EBITDA to try to normalize it for, if you're a seller and a buyer comes in, what would this business look like going forward, maybe without me as an owner involved? So it's important to understand not only just reported on the page, but what other factors should be considered. So that's I think a big part of a due diligence exercise. Another big part would be looking at the debt structure and profile of the business, right? Do you have a lot of line of credits that you're drawing on constantly to keep up with cash flow needs? Do you have external debt? Does the owner or family members or other related parties have debt in the business? That trying to make sure you identify those come close of a transaction, to just understand, okay, who's responsible for paying those? Does this provide me any leverage within the transaction itself? And then how might you, as a buyer, potentially structure the deal? Hey, they've had to carry a lot of debt to keep up with cash flow. What's my financing banking structure going to look like? And then the third piece I would talk about, which you alluded to, that we kind of worked together on, was net working capital. What's the normal working capital of the business? What's the capital expenditure profile of the business? How quick do your receivables turn? How quick does inventory turn? What's that kind of normalized working capital, needs of the business? Really just keep operations going without a lot of additional cash influx, right? But again, at the end of the day, it's wanting to come up with, what's the story of the business over the last 3 to 4 years. And I would be remiss too if I didn't touch on a little bit tax due diligence.
Of course.
I think everybody, nobody likes to talk about taxes. It's kind of the elephant in the room, but I think it's really important in any due diligence exercise that you're bringing in tax experts. We typically bring in our tax experts within our firm into every diligence deal that we're working on. And it's important because it can help identify, hey, what are your state, local, federal tax requirements? Is there any potential exposure out there, right? If you sell to multiple states, are you required to do sales tax, use tax filings in multiple states? And it just kind of helps identify some of those risks, before the transaction happens, as opposed to after the fact, something happening, right? And trying to go back and negotiate. Hey, you had this big tax liability exposure that we didn't know about. Who's responsible for that? So be remiss not to at least mention it in the conversation context of due diligence.
Yeah, great. And when you're, to your first point, the quality of earnings report and looking at EBITDA, obviously, things that came about in 2020 and COVID had a big impact on many businesses. So that might have changed that year, their profits and losses for that year. You might have things in there like, PPP loan or, whatever is in there that's kind of throwing off that EBITDA number for that year. Or like you said, like one-time contracts or things that, might have come about during that year that aren't going to be sustainable or recurring going forward. So with that, I mean, when you see those types of things, the quality of earnings, does the buyer, can they go back to the seller and say, hey, I think, we maybe need to renegotiate things, or, maybe come back with a lower offer price? What do you see normally shakes out there?
Yeah, certainly. I think that, if you think about how, kind of a buyer and like a letter of intent process works, you're typically as a buyer, you're coming up with, hey, this is EBITDA you've kind of told me that I've seen. This is what I think I want to pay you for a purchase price. Now, let me do financial due diligence and understand if I was close to that number, or, hey, listen, we're pretty far off. We need to come back to the table and renegotiate. So I think that's one of the value adds of going through a diligence exercise is, instead of just seeing some numbers on a page, you can actually kind of see what's behind it. What other things could we and should we be considering? Because all those things we see those every deal that we've done here with a 3-year period. They've all had PPP loans. It feels like, and it's like, well, that's not real EBITDA. Maybe you lost a customer to COVID, or some people did great through COVID too. So it just depends. But there's simply always some items you can find, because we're really digging into your P&L at a pretty granular level, right down to that trunk house level. And I'm not going to sugarcoat it. I mean, if you're a seller and going through diligence, you're going to get a ton of questions, very granular questions about what happened over these 3 years in the business. Why did this do this? Who are your key customers? Who has the relationships? Have you done price increases over these past 3 years? So it's really, a lot of questions, a lot of data. I'm not going to lie, but I think it helps really identify, what are your revenue and expense recognition patterns? Are you following accounting, principles? That's one of the big things too. I think through it is, you might look to buy a business or going to sell your business, and I follow GAAP, accepted accounting principles. Well, sort of, maybe,
right.
And so it's good to have someone like us come in that's an expert to be like, well, you're almost there in this front, but this is what it would look like if you were fully GAAP, right? So it's a pretty detailed exercise on the P&L, but it helps to just, for like a buyer, you said, hey, if I thought your EBITDA was this, on adjusted normalized basis, it's really this. We need to probably have a conversation about it.
Yeah, exactly. And that kind of brings me to my next question, or what's typically the key focus areas during the financial due diligence, and typically what does that process look like?
Yeah, so I think process wise, I mean, I think Aaron, I listened to you and Aaron talk. Let's say, I mean, there's typically a big data room and data request list about, hey, I need all of your monthly financial information for the last 3 or 4 years. I need certain customer contracts. I need copies of leases, any outside third parties that are involved. I mean, there's a lot of data that goes into it, but ultimately then it's us being able to kind of analyze that data and really look at month by month trends, really at that lowest level of detail, to see spikes and drops and valleys and peaks and all that fun stuff about, well, what happened this month? Why did this happen? Is this a one-time thing? So it's, I'd say the heavy areas we focus on a lot, obviously revenue, looking at your customer base, how you price either your services or your sales. Have you done price increases? How long have you had certain customers, right? Did you lose customers? That's a heavy focus, I would say. And then on the expense side, I think typically, salaries and wages is always a big area with most businesses. So, hey, what's your employee base look like over the last 3 years? Did you hire a bunch of people? Did you pay them more? Do you have bonuses, commissions? So there's certain key areas, I would say, that are always heavy focus areas around revenue, payroll, certain expenses. But again, we're looking at the full picture of the P&L through that exercise.
Yeah, that's vitally important now. Customer diversification is key. And as far as a timeline, how long does that process typically take? Because I can imagine a lot of it is relying on the seller to get you the information that you need. And depending on the size of the business, like you said, if some people don't use GAAP, or if it's their books aren't in order, I'm assuming that could take a while. So, I mean, typically, how long does that process take?
Yeah. So again, you hit the nail on the head, John. I mean, it's definitely dependent on kind of how quick we can get the information request from the seller. Typically, though, I think we typically are in a 30 to 45 day window. I think if you look at a lot of LOIs, there's typically that 45 to 60 day window that, hey, we're going to conduct diligence within this couple month period.
Right.
So we typically try to do it within that 30 to 45 day period. But sometimes, right, maybe the accounting system that seller uses is a challenge and a pain, and it's hard to get data out.
Right.
Again, we typically like to kick off with just kind of overview of the business, get to know the people we're going to be working with, let us get a bunch of data and gather it, and then spend, honestly, a series of interviews. I don't like the term interviews, but really spending, blocking out 3 to 4 different 2-3 hour blocks of time with either the owner or always like, typically the key accounting, CFO, controller, to just walk through the questions in the business over that 30 to 45-day period.
Yeah, that's very intensive, right? Because when I hear financial due diligence, I think of the basic financial reports, right? You got your balance sheet, you got your income statement, maybe a statement of cash flows, and you're good, right? It seems like there's obviously a lot more to it than people would think about, even for businesses that seem, simple in nature, right? If it's a distributing business, inventory in, accounts receivable, here's your receivables, here's your payables, here's your cash, right? So I in my mind, that can be eye-opening for people when they think about, like you said, the full interview process, customer lists, employee base, things like that is definitely pretty, can be intense and maybe sometimes daunting for people.
Yeah. And I think though, at the end of the day, our goal working either with buyer or seller is to make it as painless as possible. But, especially if we're representing, a seller that's going to be going to market, I mean, they're going to get those questions from a buyer who's going to bring in their own side due diligence team. And if we can at least go through that process with you, you might be able to answer a lot of the questions ahead of time, right? Just anticipate what's going to be asked. So again, I think it's valuable, both on the sell side and then obviously, of course, on the buy side. But yeah, it's intensive for sure. I think business owners maybe aren't, like you said, they're probably just, well, I got my P&L, I can send that to you. I know what my trends are, but it's really a bit more involved than that.
Right. Definitely. Yes. And then, the next question around networking capital, I know this can be, pretty, another kind of sticking point. Sometimes this could drive really the whole deal, right? I mean, networking capital can be such a big, important part of it. So what is networking capital and why is that important when you're going through a transaction?
Yeah. So, I think on its most basic level definitional, it's those current assets you have in the business less your current liabilities. So, think about your inventory, your receivables, right? Those current assets or items that you got to purchase inventory to sell it. You track receivables and how much people owe you. On the liability side, you've got accounts payable, right? How much do I owe at the end of every month? Do I have any accrued payroll, vacation bonus type payouts? So really trying to come up with what is, what are my current assets over my current liabilities? So the thought is if you business had to go bankrupt or whatever, you could essentially use your current assets to pay off your current liabilities, right? Yeah. Without you could sell off your inventory, collect your receivables, pay off your liabilities, and not have to influx more cash into the business. And I think it's definitely important because if you're a buyer coming into business, like your goal would be like, hey, I want the most deals, I should step back, are cash-free, debt-free deals, at least that we see, right? That means that the cash that the seller has is not going to stay in the business, right? The seller is going to take that with them because they need that to pay off their old debt or whatever. So you're not really starting with cash day one in the business, right? So as a buyer, you want, I know John knows that all too well, right? You want those current assets and networking capital to be left in the business so that you don't have to input a bunch of cash up front. You can sell your inventory, collect your receivables to keep operating normally. So it's, in an ideal world, you look at your networking capital over a 3, 6, 12 month kind of average, and then what the seller kind of brings to the table at the end. Hopefully it's close to that target, and nobody's writing a big check to the other person. Right. But I'll say that oftentimes seems to be one of the last things that kind of comes together as part of a deal. And I think at least with due diligence, that's one of the things that we always do is a networking capital analysis and a schedule. So at least start thinking about, is there seasonality in the business? Are there trends that we need to be thinking about now before we close? Right.
And in doing that, right. So you've got, like you said, the basic definition, current assets minus current liabilities. And then there's other items you need to determine, right? Like how long are you taking an average of that? How do you set kind of that peg number, and then to determine, okay, if it came in above or below, and then how long are you looking back, right? Is it 6 months? Is it 12 months? Is it 2 years? Is that all kind of involved in the process, and
Yeah,
who
yeah,
determines some of those parameters?
yeah. And I think, we certainly always will provide kind of analysis, like here's just what it is over like a 24-month period, just so we have the data. A lot of times those kind of pegs are defined right in the LOI or the purchase agreement. And I would say that those are things you should be thinking about while putting an LOI or purchase agreement together. I would say typically you see 12-month averages still, but I think in times of weird economic conditions, maybe like we're going through right now, maybe a shorter 3-6 month peg makes more sense.
Right.
But again, I think it's just understanding that that's an important part of a transaction, kind of as you're thinking about an LOI and a purchase agreement, and not just letting it be an afterthought.
Right. Yeah, that's definitely something that if the lawyer draws up the LOI, you definitely want to read over that network and capital section a couple different times and get clarity.
Well, that's the thing too, and you should have clarity on how it's defined, right? Is our net working capital definition going to be this is in accordance with general accepted accounting principles, right? Or that's what I recommend always. Or is it going to be how it's been historically accounted, even if there's some areas that aren't gaps? So again, it's just something that can be a little bit of a sticking point, I think, especially at the end of transactions.
Yeah, exactly. So yeah, I mean, that brings me to my last question is, if somebody's going through this process, when's a good time to engage with you and your team to bring you in to really start to do some of this financial due diligence?
Yeah. So I would say from a buy side perspective, working with buyers, I would say, we typically come into play after an LOI is signed, which, a lot of times that's maybe because the data, the buyer or the seller won't provide the data until there's an LOI.
Mm-hmm.
So a lot of times, I think when we come in on the buy side, kind of an LOI and an initial like purchase price has kind of been sort of agreed to in principle, right? But then the importance of it is then we've got that 30 to 60 day window to kind of validate that. Now, if you're able to bring in, diligence team before an LOI, that'd be great. I just feel like it often on the buy side, it's kind of after that LOI is kind of where we get kicked off.
Yeah, right.
On the sell side, I think it can really vary, and it can vary depending on maybe kind of when your go-to-market strategy is. We have some where, hey, we think we want to go to market 3 to 4 months from now, but let's start the sell side diligence process now so that we know kind of those risks and warts, if you will.
Right.
Might be the numbers. Let's get ahead of that. Let's just present those in any materials we go to market with that, hey, we know about these adjustments or things that maybe aren't wrong, but things that should be considered, right, for potential buyers out there. So I think typically we come in a little bit earlier in those process.
Right.
Again, it can vary in both situations.
Yeah. Well, great. So Griffin, I appreciate you joining us today and walking us through the financial due diligence process. It's obviously something that's very critical, when buying or selling a business. It's something that, you may think you have a good understanding of accounting and, income statements and balance sheets, but there's really a lot more to it than just simply looking at a couple reports. So I appreciate the information you shared, and definitely I'll have your contact information for those out there that might be looking to, buy or sell their business and need some help with the due diligence process.
Yeah, no, appreciate it, John. Thanks for the opportunity, and thanks again.
All right. Thanks, Griffin. Have a good one.
See you, John.